Did you know that most people who start investing end up losing money? Not because the market is against them, but because of their own mistakes. Studies show that around 90% of retail investors fail to achieve consistent profits. But why does this happen? And more importantly, how can you avoid becoming part of that statistic? The truth is, investing isn't just about picking the right stocks or jumping on the latest trend. If it were that simple, everyone would be rich. The biggest reasons people fail have more to do with psychology than finance. Emotions, impulsive decisions, and unrealistic expectations are what destroy portfolios, not the market itself. Take, for example, the classic case of panic selling. The market drops, fear kicks in, and people sell at the worst possible time. Then, when the market rebounds, they hesitate to get back in, missing the recovery. This cycle of fear and greed is what keeps most people from ever building real wealth. But the most dangerous mistake? Thinking short-term in a long-term game. Many investors approach the market like a casino, expecting instant results. They chase quick gains, buy into hype, and ignore fundamental principles of wealth building. The result? They burn out, lose money, and give up before ever seeing success. Here's the good news: you don't have to be one of them. In the next part, we'll break down the key mindset shifts that separate successful investors from those who fail. And by the end of this, you'll know exactly how to turn the odds in your favor. So, if emotions and short-term thinking are the biggest reasons investors fail, what does it take to succeed? The answer isn't some secret strategy or hidden stock picks. It's about mastering your mindset and approach. Because at the end of the day, investing isn't about being the smartest person in the room. It's about having the discipline to stick to a plan when everyone else is panicking. Most people enter the market with the wrong expectations. They hear stories of someone making thousands overnight with a lucky trade and believe they can do the same. The reality? That's not investing, that's gambling. And like a casino, the house always wins in the long run. Look at Warren Buffett. He's often quoted saying, "The stock market is a device for transferring money from the impatient to the patient." Why? Because long-term investors let compound interest do the heavy lifting. The difference between a trader trying to double their money in a year and an investor compounding at 10% annually over decades is massive. Consider this. If you invested $10,000 and achieved a 10% return per year, after 30 years you'd have nearly $200,000. But if you chased risky trades and lost half your capital along the way, you'd spend years just trying to recover. The key is time in the market, not timing the market. Many new investors obsess over getting in at the perfect moment. They wait for dips, second-guess themselves, and hesitate because they fear making a mistake. But here's the harsh truth. There is no perfect time to invest. Even the most successful investors can't consistently predict market tops and bottoms. Instead of trying to time the market, they focus on steady, disciplined investing. That's why strategies like dollar cost averaging, DCA, exist. With DCA, you invest a fixed amount regularly, whether the market is up or down. This removes emotion from the equation and ensures that you don't accidentally invest everything at a peak or miss out during a dip. Over time, this strategy lowers your average cost per share and smooths out volatility. Take the S&P 500 as an example. If you had invested a lump sum of $1,000 at the worst possible moment before a crash, you'd feel the pain. But if you had invested $100 per month over 10 years, those market fluctuations would work in your favor. You'd be buying at both highs and lows, ultimately reducing risk and increasing returns. One of the biggest mistakes failing investors make is only thinking about returns, not risk. They chase the highest yielding investments without considering what could go wrong. The problem? When things go south, they aren't prepared. Smart investors always ask, "What's my downside? How much am I willing to lose? What's my exit strategy if things don't go as planned?" This is why diversification is crucial. If you put all your money into a single stock or cryptocurrency and it crashes, your entire portfolio takes the hit. But if you spread your investments across stocks, bonds, real estate, and alternative assets, one bad investment won't wipe you out. Hedge funds and professional investors don't take unnecessary risks. They hedge their bets. They understand that preserving capital is just as important as growing it. If you lose 50% of your investment, you don't need a 50% gain to break even. You need a 100% gain. That's why successful investors focus just as much on not losing money as they do on making it. The average person gets into investing without ever learning the basics. They follow social media hype, buy into stocks because someone on YouTube said so, and jump on trends without understanding what they're investing in. Here's a question. Would you buy a house without checking its condition, location, or price? Probably not. Yet people do this all the time with stocks. They invest in companies they don't understand, fueled by hype rather than research. Successful investors, on the other hand, educate themselves first. They study how to read financial statements, knowing the difference between revenue and profit, how different assets behave. Stocks, bonds, real estate, and commodities each have unique risks. How market cycles work, understanding that crashes and recoveries are normal. One of the best investors in history, Peter Lynch, said, "Know what you own and know why you own it." If you don't understand the business behind a stock, you're not investing, you're gambling. So what separates the 10% who succeed from the 90% who fail? They focus on long-term wealth, not short-term wins. They invest consistently rather than trying to time the market. They manage risk and never bet everything on one investment. They educate themselves before making financial decisions. But knowing all this isn't enough. The real key is applying it. In the final part, we'll break down the practical steps you can take right now to put these principles into action and build an investment strategy that actually works. Stay tuned. By now, it's clear why most investors fail. But what separates those who struggle from those who build real, lasting wealth? It's not luck. It's not even about picking the perfect stocks. The real difference comes down to having a strategy and the discipline to stick with it. If you want to be in the 10% who succeed, you need a plan. One that removes emotions, eliminates guesswork, and keeps you on track even when the market is chaotic. And that's exactly what we're about to break down. Step 1. Set clear investment goals. Most people invest with a vague hope of getting rich. They throw money into stocks, crypto, or real estate without ever defining what they actually want to achieve. But investing without a goal is like setting off on a journey without a destination. You'll get lost along the way. The most successful investors don't just invest for the sake of investing. They set clear, measurable goals. Some are investing for retirement, knowing they won't touch their money for decades. Others want to build passive income, so they focus on dividend stocks or rental properties. Some are saving to buy a home, which means they need a safer, more stable strategy. Each goal determines how you should invest. If you need the money soon, you can't afford high-risk volatile assets. If you're playing the long game, you can weather short-term losses for bigger gains down the road. The key is to align your strategy with your timeline and risk tolerance. Step 2. Choose the right investment approach. There's no single best way to invest, only the best approach for your situation. But one thing is certain, chasing quick wins is not a strategy. Some of the world's wealthiest investors take a passive approach, using index funds to capture market returns over time. Investing in something like the S&P 500 or the MSCI World Index doesn't require constant buying and selling. It simply grows as the global economy expands. This method has built more millionaires than stock picking ever has. Others prefer dividend investing, focusing on companies that pay steady cash flow. A well-built dividend portfolio can eventually replace a salary, providing income without having to sell shares. Then there are those who go for high-growth stocks, companies with massive potential but also higher risks. While some of these investments can deliver outsized returns, they also come with volatility, which makes them a poor fit for impatient investors. And finally, real estate and alternative assets give investors another way to build wealth outside of stocks. Some choose rental properties, while others invest in REITs to earn passive income from real estate without the hassle of managing tenants. The approach you choose depends on your risk tolerance, timeline, and financial goals. But no matter which path you take, one rule remains: stay consistent. Step 3. Automate your investments. Many investors fail not because they pick the wrong assets, but because they lack consistency. They invest sporadically, putting in money when they feel confident and pulling out when fear sets in. But the market doesn't reward emotional decision-making, it rewards discipline. That's why successful investors remove emotion from the equation. They set up automatic contributions, investing a set amount every month regardless of market conditions. When the market is high, their money buys fewer shares. When the market crashes, their money buys more. Over time, this strategy, known as dollar cost averaging, smooths out volatility and keeps them invested when others panic. By automating your investments, you ensure that you're always building wealth, no matter what's happening in the market. Step 4. Manage risk like a pro. Many investors obsess over potential returns but ignore risk. They see the upside but fail to consider how much they could lose. And when things go wrong, they panic, sell at a loss, and swear off investing forever. But the best investors think differently. They ask themselves, how much am I willing to lose? Before they even make an investment, they spread their money across different assets, industries, and markets to avoid catastrophic losses. They also keep cash reserves, ensuring that if an emergency arises, they won't be forced to sell investments at the worst possible time. A simple rule of thumb is to have at least 3 to 6 months of living expenses saved before going all in on investing. Risk management isn't about avoiding losses, it's about surviving them. Because in investing, those who stay in the game the longest always come out ahead. Step 5. Master your emotions. Even with the perfect strategy, emotions will always be your biggest enemy. Fear makes people sell at the worst time. Greed makes them chase hype and lose money. The key to long-term success is learning to detach emotions from your investments. The market will crash. It always does. And when it happens, the media will flood you with panic-inducing headlines, convincing you that the world is ending. But history tells a different story. Every crash has been followed by a recovery. The people who sell in fear lock in their losses. The ones who stay calm and keep investing reap the rewards when the market rebounds. The best investors understand that wealth building is a long-term game. They don't check their portfolio every day because they know that short-term fluctuations don't matter. They trust the process and let time do the heavy lifting. Most people fail at investing because they let fear, impatience, and a lack of strategy dictate their decisions. But those who succeed follow a simple, proven formula. They invest with a clear purpose. They stick to a strategy that fits their goals. They automate their investments to remove emotion. They manage risk instead of chasing rewards. They stay patient, letting time and compound growth work for them. At the end of the day, investing isn't about luck or intelligence. It's about consistency and discipline. The biggest mistake isn't choosing the wrong stock or missing the perfect buying opportunity. The biggest mistake is not investing at all. The best time to start was yesterday. The second best time? Right now. The longer you wait, the harder it becomes to build real wealth. So take action today because your future self will thank you for it. And that's it. Now you know exactly why most people fail at investing, and more importantly, how to avoid their mistakes. The difference between those who struggle and those who build real wealth isn't luck or secret strategies. It's mindset, consistency, and discipline. If you found this valuable, make sure to subscribe so you don't miss future videos on smart investing and financial growth. And let me know in the comments, what's the biggest investing mistake you've learned from? The best time to start investing was yesterday. The second best time? Right now. So take action, stay patient, and let your money work for you.